one errant missile or one false move, then things could be right back into crisis mode. But there's just no doubt that the oil markets in particular are pricing in containment, not spread. And express our hope that in fact comes to pass, that a resolution acceptable to all sides is found post haste, and that we can get about the task of normal life once again.
This is Kaiser Johnson with Liberty in Finance, and this is our weekly special for November 20th through November 27th, 2023, while supplies last. First this week, we feature 1/10-ounce gold eagles at just $32 over melt. Next, the Royal Canadian Mint's half-ounce silver polar bears are available at just $2.35 over melt per coin. Both our specials this week are IRA eligible. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend Doomberg from the very popular Doomberg Substack channel. And it is, as far as I know, the number one financial contributor on Substack. So thank you so much for joining us today, Doomberg.
Elijah, great to be here, and always nice to hear that descriptor. We are, in fact, yes, the number one paid finance Substack in the world, which is amazing and humbling and thrilling all at the same time. So real pleasure to be here with you again.
Last time we had you on, we discussed the Middle East conflict and how it might impact energy prices. Now, we've seen kind of counterintuitive action in the markets. We're seeing a rallying stock market. We're seeing falling oil. At the same time, we're seeing this huge conflict still play out in the Middle East. So your perspective on what's happening right now?
Yeah, I believe the last time I was on, we discussed how the oil market was basically a proxy for whether the market believed that the war in the Middle East would spread, and specifically whether a kinetic conflict would break out between the U.S. And Iran. And I would say that the market is still anticipating that the situation in Israel will be contained largely to the Gaza Strip. Action on the ground would seem to indicate, risks to the opposite side of that, but the market is certainly not pricing in a widening war, but in fact seems to be pricing in containment. And an underreported event occurred this week, I would say. Saudi Arabia hosted a summit of Arab and Muslim countries, and dozens of leaders from the Arab world were in attendance. And I think the Arab world is sort of uniting around a desire to contain the situation. There wasn't a sort of typical bellicose type inflammatory rhetoric that you might find. Obviously, they were strongly opposed to what Israel is doing, but and the U.S. is help in that regard. But I think the picture that may have sent oil prices a bit lower, that again almost nobody in the West is reporting on, is a picture of the president of Iran sitting down with MBS, and that was an image that would have been unthinkable a year ago. 18 months ago, for sure. And so I think a unified OPEC is sort of counterintuitively rounding out the edges of extremism, perhaps, in the response to what's going on in the Middle East. And that's the best explanation I could come up with for the relative weakness in oil, even as the rest of the stock market has decided that the Fed is done raising interest rates and perhaps will begin soon to cut. And so that's the lay of the land as we talk today. But of course, one errant missile or one false move, then things could be right back into crisis mode. But there's just no doubt that the oil markets in particular are pricing in containment, not spread.
Do you have any forecasts on that? I obviously, it's a hard thing to predict, but do you think we're out of the woods in this conflict or not?
I certainly hope so. It's the result that everybody should be hoping and praying for, I would say. War is a terrible thing. Sometimes it's necessary, and it's a whole different discussion to go down that road. But we would be decidedly in the pro-peace camp, and we would hope that this situation gets contained, that a durable peace in the Middle East can be found, which of course is perhaps the toughest of the Gordian knots to untie in the history of geopolitics. And so I could only go with what the market is telling us, which is that the situation seems to be contained, and express our hope that in fact comes to pass, that a resolution acceptable to all sides is found post haste, and that we can get about the task of normal life once again.
I did want to discuss your perspective also on the topic of energy. The winter in Europe, I know last year was a close call. A lot of people were concerned about Europe not having enough heat for the winter. Your perspective on, as we enter into the winter this year, where does Europe stand and how is it going to get enough energy?
So it stands in better shape than it did last year, when it was the beneficiary of a surprisingly warm winter, thankfully. It's a little too soon to tell on how the winter is going to go this year. But as far as, like gas storage and preparedness, I would say it's simply undeniable that Europe is in better shape than it was at this time last year. And this is probably the last winter of significant risk for the region. But, much depends again on the weather. And I was just sort of pulling up some data as we're talking, and it's trending. November is trending a little bit warmer than historical, perhaps slightly cooler than last November, but the real test will come in December and January. There's a great website for those who are interested called weatherspark.com, where you can pull up for virtually every city in the world how the current temperature patterns are trending versus several standard deviations, from 25th to 75th percentile and 10th to 90th percentile, both on the warm and the cold side. And the city I like to watch as a proxy for the weather in Western Europe is the temperature gauge at Frankfurt. And so that's what I check at least once a week, see how things are going. And in the last couple of days have trended in the sort of 70th percentile to the warm side. And so we shall see. But, the temperatures bottom out in December and January, and that's when the preparedness will be put to the full test.
We do have some viewers' questions on energy. This viewer is wanting to know, with inflationary forces in the mix for various reasons, doesn't energy ultimately trump everything from a counter-inflationary asset standpoint? Yeah,
the energy prices are skyrocketing, and then inflationary pressures swiftly follow, which is what we saw. The CPI readout from the impact of the 2021-2022 energy crisis played out, for quite some time. And it wasn't until energy prices came in off the highs that we started to see a slowing rate of inflation back down to more reasonable levels that we see today, and that the market seems to be exceedingly excited about. So yes, when we think about inflationary pressures, one of the charts we'd like to keep a close eye on is the price of diesel, since diesel is so important to virtually all parts of the economy. And refining margins have been under pressure these last few weeks, which is only going to help. I think gasoline at the national level will probably dip below $3 a gallon. These are all good things for the consumer, good things for the economy, bad things for energy investors and for owners of energy equities in particular. But these things are cyclical. But right now, again, much like oil is not pricing in a spreading war in the Middle East, the refinery markets, for refined products is signaling easing inflationary pressures, which is probably one of the reasons why the market is convinced that the Fed may be done with its tightening cycle.
Christopher wants to know, best natural gas plays, and when should we see natural gas repriced or re-elevated?
Natural gas is very tricky. We would stay clear of directly investing in natural gas. It's not what we do, but also because it's known as the Widowmaker trade for a reason. And we just wrote out a piece with a cheeky title called McKibben with Fries, where we talked about there's growing pressure on limiting U.S. LNG exports on the part of environmentalists. They're pressuring the Biden campaign to limit new export licenses and even trying to get them to roll back existing ones. And we talked through some of the consequences that would entail. If the U.S. suddenly stopped exporting LNG, prices for natural gas in the U.S. could turn negative. Natural gas is an exceptionally regional market. And one person's supply glut is another person's energy crisis, depending on the infrastructure that connects the two. And in the U.S., we are swimming in natural gas. It is dirt cheap on an energy content basis. It's a true luxury for U.S. homeowners who have, especially in the colder parts of the country, who use natural gas to heat their homes, and for U.S. manufacturers who rely on natural gas to power many of their facilities. This is a boon. At $3 and change per million BTU, that's the energy equivalent price of about $20 a barrel of oil. That price could go negative. It has gone negative in parts of the country, in the Permian Basin in particular. In the long run, we believe that global natural gas prices have to harmonize as investments in LNG export and import facilities come online. We believe the way they'll harmonize is LNG prices will come down and perhaps U.S. prices will go up. But if there's any sudden disruption in the U.S., you could see natural gas prices plummet even to levels that are unthinkable. And in fact, one of the main drivers for this, of course, is that natural gas is produced in huge quantities in the U.S. as a byproduct of the production of oil in the Permian Basin. And in the Permian Basin, natural gas has already gone negative in the past year. And absent new pipeline infrastructure, which is scheduled to come online, which will relieve some of that pressure, we could easily see prices continue to drop. So we would be cautious in playing the natural gas markets just because it's so regional. The prices are so inelastic, and you're one explosion at a facility away from dramatic price changes in the markets.
I know your latest piece is on natural gas and how obviously the U.S. has a plentiful supply of it. And the interesting dilemma that President Biden is in right now, your perspective on whether, to limit the exports of natural gas or not, how that decision could impact Europe and other areas of the globe.
Yeah, as we highlighted in the piece, environmentalists have zeroed in on methane emissions as the next great boogeyman for climate change. And they're citing a study from a professor at a major U.S. university saying that the LNG is in fact worse for the climate than even burning coal. And so whether or not you believe those things to be true, I think it's important to recognize where the environmental left is going. And as we come up on an election year, this is not something to be ignored. And do we think Biden is likely to support a repeal of U.S. LNG export licenses? I mean, of course not. I think that would be very difficult to explain to his geopolitical allies. And at the same time, he is trying to stop Russian LNG from coming onto the market. He needs to be able to have replacement LNG for people who would forego paying Putin for their natural gas. And so, but at the same time, the Department of Energy is, in fact, slow rolling new approvals of export licenses. The industry is starting to rumble that certain project timelines might be missed if the government continues to stall. I think Biden is going to try to have it both ways, which is, avoiding major headlines about new approvals, but at the same time, winking to the industry that they should continue to invest, because ultimately, once we get on the other side of the election, he would view increasing LNG exports as a critical weapon in the U.S. geopolitical front. The president has to balance the economy, geopolitics, and the environment. And we walked through the impact of what such a decision would have on various markets. It was a fun piece to write. It was well received by our subscribers.
Roger wants to know, in my travels, I'm seeing a large amount of drilling for natural gas in the Greeley, Colorado area, and many large dairies and feedlots putting up methane digesters. Will the natural gas demand keep up with the increasing supply that appears to be coming online?
So there's several factors in play, and including one that we're going to be publishing on shortly after we conclude this interview, which is the helium dynamics. And in fact, in some parts of Colorado, I suspect that there's some ample byproduct helium to be had, which can justify drilling even in the face of a shortage of demand for the actual primary product you're drilling for. Helium is an incredibly poorly understood commodity, really fascinating topic that we're writing about. The U.S. has a helium reserve that it has drained. It's got all kinds of fascinating tidbits, which you'll read in the next Doomberg piece. But yeah, the drilling for natural gas in the U.S., the natural gas has become, the U.S. has brought on essentially an energy equivalent of Saudi Arabia in its growth in natural gas production. It's just really amazing. And it's a shame that we can't find better uses for it. We flare some of it. We export a ton of it. We export almost as much natural gas on an energy basis as we burn using coal in this country. We could actually replace all of our coal plants with natural gas if we were a little smarter about it. It's not really, it's unfair to say smart, but because these things ebb and flow. But yeah, another reason that I would be cautious on U.S. natural gas prices is because we just have such a glut of supply of it. A bunch of it is produced for reasons beyond natural gas, including the co-production of oil, as I alluded to, and then, of course, this helium market, which very few people are thinking about as well.
This viewer asks, a lot of people are thinking about the housing market and also the impact that money creation, currency creation by the Fed has on the housing market. And if the Federal Reserve is just going to continue, if they're going to go back to easing, printing, and creating more currency, won't that just elevate housing prices? And I'm assuming what the viewer is kind of pointing out, that a lot of people are thinking that the housing market is in a bubble right now and prices are going to crash. So the question is, do you think that crash is going to happen, or do you think more money creation will just prop up that bubble again?
I think it's a little more nuanced than that. I will say up front that the housing market is not our primary domain of expertise. Being a homeowner, I certainly participate in it and follow prices. Interestingly, there's an interesting situation that's unfolding, at least in our local market. And I talk to friends who have invested in, in other markets across the country. The cost to build has skyrocketed. The cost to build new is skyrocketed to the point where it's difficult to build a home for less than you could buy an equivalent one for, assuming they're available on the market. The challenge, of course, with 8% interest rates is it's crimping out the affordability for many people as well. And then there's a whole cadre of people who are sitting on mortgages of 2% and 3% and 4% that just would never sell because they're essentially, their mortgage is cheaper than the interest rates they can get on a T-bill these days. And so it's a very fascinating setup. If you would have told me that mortgage rates would have spiked to 8% on a 30-year fixed, that and the housing market would not have crashed, I would have been surprised. But it's been surprisingly resilient. I think it comes down to regional supply-demand dynamics, affordability, and to the marginal buyer who can afford it. Prices, the mortgage rates don't seem to be impacting them. So I think we're seeing a fascinating situation. I can tell you that building new right now with the inflationary pressures and shortages of labor and so on is becoming ever more challenging, at the same time that people are refusing to put their houses necessarily on the market because they're sitting on advantageous mortgages. So how that all plays out is really beyond our expertise.
Now, moving to precious metals, this viewer wants to know if you have an opinion on the projected silver deficit in the future, especially for usage because obviously there is going to be increased usage for solar panels and EVs, etc. So your perspective on that topic.
Yeah, the thing about silver that makes it different from gold is that it has a sizable industrial application, namely being used in the production of solar panels. Looking across the sort of renewable energy markets, the market seems to be discounting the green revolution here. And so if your investment thesis relies on a continued proliferation of solar, there are other signals in the market that just might not be materializing. In particular, I would say that take a close look at the price of copper. If there is going to be this green energy revolution that has been talked about by so many people, you would expect that copper prices would be far firmer than they are today. And we have been signaling for most of this year that the markets are indicating, whether you look at cobalt, nickel, lithium, copper, that perhaps we have seen peak ESG, and that mania may well be on the descent. And if that's true, then some of the more bullish forecasts for consumption of silver in the renewable energy space might also fail to materialize. And so we are, of course, precious metal owners, but not for an investment. It's a vehicle for saving for us. And speculating in the silver markets is akin to speculating in natural gas, in our view. Very dangerous trade to make, and one that we feel as though we would have no edge in putting on.
And in your perspective, really, the precious metals are more of savings rather than speculations?
Yeah, in particular, gold. I think I've mentioned before that we earn in fiat and we save by buying real assets, and we invest privately where we can affect the outcome. And in a subset of saving by buying real assets would include gold, silver, collectibles, land, and so on, things that have a durable value outside of the fiat currency situation that was alluded to in one of the earlier questions. And invest privately means, of course, where we can get to know the management team directly, help them run the company with our contacts and network and expertise. And also, the private market's a little less efficient. You can gain an edge through a variety of ways. And so we would resist the temptation to speculate in precious metals. But I, for example, personally allocate a certain percentage of my monthly income to gold as a savings vehicle. And I just don't think about it as an investment. I count the worth of my gold in ounces, not in dollars.
We have a viewer's question on the stock market. And a lot of people in our viewers are really concerned about the valuations of the stock market, seeing that they're overvalued, and definitely looking at last year's performance are concerned, like I said, about a possible crash coming in the near future. This viewer wants to know your perspective on, do you see markets rallying with other intangible assets as everyone tries to dump government debt globally in the coming future? I know we've seen also a downturn in the bond market, and typically those don't happen at the same time. But your perspective, I guess, moving forward here, your outlook on the stock market, especially with respect to the bond market.
Yeah, again, I wouldn't have much to add to what's already out there, although I do say I'm an avid reader of my friend Tony Greer's daily trading letter. And for those who are interested in sort of short-term movements in the stock market, he's far better than I at predicting these things. You can find him at tgmacro.com. Great friend of mine. I'm in his Slack channel. And he came out with an extraordinarily bullish note the morning that the markets really took off on the weaker than expected CPI print. And I would say, even though we're titled Doomberg, waiting around for a crash can often cause you to miss significant upward swings in the markets. I know that I was hovering over the buy button shortly after the COVID crisis on a few equities that I thought were rock solid in the mining sector with excellent balance sheets, and I didn't hit buy. And it was one of my big regrets because I was worried that the crash wasn't over. And timing these types of things is very challenging, especially for retail investors. I mean, there are people who are far better at it than I, and I would recommend that your viewers go check out their work. Tony's a good guy and really ex-Goldman trader and spends a lot of time studying and analyzing the markets on a daily basis.
Definitely. We do have another question here that slightly relates to the bond market. It's about U.S. debt. What is the real status of the debt of China compared to the U.S.?
Yeah, China's a real black box, as we've talked about before. It's difficult for Western analysts to get a handle on what's really going on inside. I would note that President Xi struck a very collaborative tone in his recent visit to San Francisco, notwithstanding President Biden's labeling him as a dictator shortly afterwards and potentially jeopardizing any of the progress that was achieved. But he gave a very conciliatory speech to U.S. business leaders. Some have applied a bit of cynicism in interpreting his motivations for giving that speech, namely that his country is experiencing significant economic challenges, and he's here hoping for a boost in direct foreign investment that can help offset some of those troubles. But if you take him at his word, which is always a risky thing to do, it would seem that China is interested in fixing whatever challenges that ail them. And when you're trying to study markets, again, you always have to ask yourself what's priced in. And so you're really looking for inflection points in the market where if everyone believes China's struggling and then Xi strikes a conciliatory tone greater than what the market thinks, then you might see, a more bullish sentiment flowing into stocks. Trying to understand, what goes on in China, though, from here is a very difficult challenge. And I would argue that a few do it well.
Now, as we talk about the financial situations of different countries across the globe, obviously the US has played a major role in the last century, kind of being the main power out there, but that is changing. Roger also wants to know about the BRICS and their possible alternative to a SWIFT system. He says he's heard of them possibly developing something like that. And he's wondering if you have any information on that, of how that might work.
Yeah, we have been broadly bearish such talk. And, we put out a piece ahead of the infamous BRICS summit where we indicated that in our view, this was going to take far longer, go much slower, and have far less of an impact than perhaps some people in the gold community in particular were hoping. I think that the great secret hope here, if it's not always expressed, is that gold will be at the center of a new BRICS currency system as a neutral reserve asset for settling trade imbalances, and that this will finally remove the veil of price manipulation in the paper markets in gold. And I'd be the first to hope all those things occur. I just think that it's going to take a long time, move a lot slower than people think, and likely to have less of an impact than many are hoping for. That being said, the trend is clear, and it's in one direction, which is the global South, call it BRICS, call it the global South, is interested in getting out from under the US dollar system, and they are slowly chipping away at building the infrastructure to do it. And over time, I suspect we'll see a fragmenting of the currency markets into sort of the G7 Western world and the global South, headlined by China, Russia, and the OPEC producing countries, which are joining BRICS as we speak. And so, but again, this is a decades-long phenomenon, not a weeks-long phenomenon. Certainly, at least years, if not decades, before we begin to see material change in our view.
Doomberg, we really appreciate your time today. Where can our viewers find you online if they're interested in learning more?
Yeah, everything we do is available at doomberg.substack.com, including our articles, our pro tier, where we do a monthly Doom Zoom, which usually involves in-depth presentations delivered by me on topics of interest to our subscribers, or really amazing guests who deliver presentations themselves, and I do a bit of Q&A with them. Also, we have a link to all of our podcast appearances, and this one will be up there. You could check on our Doomcasts page, and every podcast that I've been a guest on is listed there as well. And I would say one point to make here is that subscribers also get access to our comments section, and every time we publish a piece, we get several hundred really intelligent comments. We do sort of monitor it to make sure that there's nothing out of line. It's kind of an adult conversation behind the paywall. Lots of interesting links and follow-ups. And that's where our subscribers get to critique our work as well. Sometimes we get a few things incorrect or omit a few important points, and it's always good to learn from our subscribers. And so if you're looking for a place on the internet to have reasoned discourse with intelligent adults, I would say that the Doomberg comments section, you could do worse than that.
Fantastic. Well, Doomberg, we really appreciate your time as always. Thank you so much, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.